The financial crisis of 2008, also known as the Great Recession or the subprime mortgage crisis, is arguably the second most important economic and financial downturn in modern history after the Great Depression, in terms of intensity, depth, and magnitude. The crash of the housing market triggered the financial crisis. The outcome was marked by sharp declines in GDP, massive job losses, over 8.7 million in the U.S. alone, and a global credit freeze. Unlike the Great Depression, which lasted over a whole decade due to the interventionist policies of Herbert Hoover and FDR, the financial crisis of 2008 only lasted 18 months, from December 2007 to June 2009. The Obama administration and the Federal Reserve passed a series of interventionist policies to attenuate the crisis and mitigate its impact. Yet, its impact on the middle class and the working class was non-negligible. Many working families lost their homes, which were their main asset, and their jobs, which created an intense panic on Main Street, while Wall Street was rescued by the federal government. Once again, it is important to distinguish what triggered the financial crisis from what caused it. And more importantly, why wasn't the Great Recession as long as the Great Depression? The financial crisis of 2008 was triggered by the bursting of the U.S. housing bubble in 2006-2007, coupled with the collapse of the subprime mortgage market. This led to widespread defaults on high-risk home loans, devaluing mortgage-backed securities, MBS, and related derivatives held by banks worldwide. The immediate spark that intensified the crisis into a full-blown financial panic was the bankruptcy of Lehman Brothers on September 15, 2008, the largest in U.S. history, which eroded confidence, froze credit markets, and accelerated the recession. In the early 2000s, lenders offered high-risk loans, subprime, to borrowers with poor credit, often with low introductory rates that later skyrocketed. Cheap credit and lax standards inflated a massive housing bubble, with prices rising rapidly, making people believe real estate was a guaranteed profit. As interest rates rose and home prices fell, many borrowers couldn't pay or refinance, leading to mass foreclosures and defaults, crashing the market. The collapse of MBS values triggered panic. Banks stopped lending to each other. Major institutions failed, like Lehman Brothers, and the crisis spread globally, causing widespread job losses and recession. There are a few causes that triggered the subprime mortgage crisis. First of all, there is the American Dream Down Payment Act, known as ADDA or ADDI. This law was implemented by the Bush administration in 2003. Indeed, President Bush promoted the narrative of homeownership as the fulfillment of the American dream. He argued that the American dream should be accessible to everyone, and that fulfilling the American dream is to own a home. Thus, he signed into law the American Dream Down Payment Act, a law providing grants for low-income, first-time homebuyers via the Department of Housing and Urban Development's Home Investment Program to cover the down payment and closing costs. The federal government provided grants up to $10,000 or 6% of the purchase price, distributed through this program. The program aimed to address a key barrier to homeownership, the inability to save for a down payment, by subsidizing these costs for eligible buyers purchasing single-family homes, including manufactured housing under certain conditions. Funding started at $75 million in fiscal year 2003 and was intended to rise to $200 million annually, potentially assisting around 40,000 families per year, though appropriations ceased after fiscal year 2008. The ADDI indirectly influenced banks' lending practices by expanding the pool of qualified borrowers. By covering down payments, it enabled more low-income individuals to meet lender requirements for conventional or FHA-insured mortgages, often allowing loan-to-value LTV ratios up to 97%. This reduced the upfront capital needed from buyers, making home loans more accessible and encouraging banks to extend credit to demographics they might otherwise view as higher risk due to limited savings. The program fostered public-private partnerships, where banks and secondary market entities like Freddie Mac could leverage ADDI funds to offer more flexible mortgage products, increase market liquidity, and boost overall lending volume to underserved markets, without solely bearing the down payment risk. This expansion of credit access increased banks' willingness to approve riskier loans, as government-backed assistance mitigated some equity concerns, but it also played a role in inflating the housing market and heightening default risks, factors that exacerbated the 2008 financial crisis. However, ADDI itself did not mandate changes to banks' underwriting standards. Its effects were more facilitative, helping borrowers qualify under existing criteria while promoting outreach to public housing residents and rental assistance recipients. The Federal Reserve was certainly not innocent in the making of the subprime mortgage crisis. Indeed, in the aftermath of the 2001 recession, the dot-com bubble burst, and the September 11th attacks, the Federal Reserve, under Chairman Alan Greenspan, adopted an expansionary monetary policy to stimulate economic recovery. The federal funds rate was slashed from 6.25% in early 2001 to a historic low of 1% by mid-2003, where it remained for a full year, resulting in negative real interest rates, after adjusting for inflation, for over 2 years. This was part of a broader effort by central banks worldwide, including the Fed, to inject liquidity into the economy and avert deflationary risks. Money supply measures like M2 grew rapidly, exceeding 8 to 10% annually in the early 2000s, far above historical norms. These actions deviated significantly from established benchmarks like the Taylor Rule, which suggests interest rates should align with inflation and output gaps. By some estimates, rates were kept 200 to 300 basis points too low from 2002 to 2005. The Fed's low-rate environment made borrowing exceptionally affordable, disproportionately channeling credit into the housing sector and inflating a bubble. Real estate loans at commercial banks expanded at a 12.26% compound annual rate from mid-2003 to mid-2007, while nominal expenditure growth accelerated from 3.6% 2001-2002 to 7.1% 2004-2005. This encouraged a shift toward adjustable-rate mortgages, ARMs, which became 194 basis points cheaper than fixed-rate options by 2004, doubling their market share to over 40% of new loans. Borrowers, including subprime ones with poor credit or limited down payments, could access financing they might not have otherwise qualified for, assuming rates would stay low and home prices would continue rising. As homeownership rates climbed above the historical 65% average, fueled by innovations like private label mortgage-backed securities, PMBS, risks were masked until prices peaked in 2006. The Fed's monetary policies created a quote-quote supply bubble, where easy money distorted asset prices and encouraged overbuilding, leading to an overhang of housing stock and eventual price collapses when rates began rising in 2004 to 2006. Simulations by the IMF and economists like John Taylor suggest that without the Fed's rate cuts, housing investment and prices would have been more contained, potentially averting the severity of the subprime meltdown. When subprime defaults surged, triggered by rate resets on ARMs and falling home values, the interconnected financial system amplified the shock, as securitized subprime loans contaminated balance sheets globally. Banks lowered their standards to increase their profits. And to do so, they used complex financial instruments, such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. It is important to highlight the difference between the two. Mortgage-backed securities, MBS, are investment products created by pooling together numerous home loans, mortgages, from banks or lenders. These pools are then sold to investors as securities, where the investors receive payments derived from the borrower's monthly mortgage repayments, including interest and principal. MBS essentially allows lenders to offload mortgages from their balance sheets, freeing up capital to issue more loans. There are different types, such as those backed by prime low-risk mortgages or subprime, higher-risk ones, and they can be further structured into tranches with varying levels of risk and return. Collateralized debt obligations, CDOs, on the other hand, are more complex structured finance products. They bundle a diverse array of debt instruments, not just mortgages, but also corporate loans, auto loans, credit card debt, and often MBS themselves, into a single security. CDOs are divided into tranches based on risk priority. Senior tranches, e.g., AAA rated, get paid first and are considered safest, while junior or mezzanine tranches, e.g., BBB rated, absorb losses first but offer higher yields. This tranching allows for risk redistribution, making CDOs appealing to investors seeking customized risk-reward profiles. A key subset relevant to the crisis was subprime CDOs, which heavily featured mezzanine tranches from subprime MBS as collateral. While all MBS are backed exclusively by mortgages, not all are CDOs. However, some MBS, like collateralized mortgage obligations or CMOs, mimic CDO structures by tranching mortgage pools. Conversely, CDOs can include MBS as part of their broader debt mix, creating an overlap that was particularly problematic during the crisis. In the lead-up to the 2007-2008 financial crisis, securitization, the process of turning loans into tradable securities like MBS and CDOs, played a pivotal role in expanding the mortgage market, especially subprime lending. Subprime mortgages were loans extended to borrowers with poor credit histories, often featuring adjustable rates that started low but could spike. Lenders originated these aggressively because they could quickly sell them off as MBS to investment banks, which in turn repackaged them into CDOs. Banks and non-bank lenders relaxed underwriting standards to meet investor appetite for high-yield securities. Subprime MBS issuance surged, with private label, non-government-backed MBS growing from about 47% to 71% of private issuances between 1996 and 2006. Investment banks pooled subprime mortgages into MBS, then took the riskier mezzanine, e.g., BBB-rated tranches of those MBS and bundled them into CDOs. Through financial engineering, about two-thirds of these CDO tranches could be rated AAA, despite the underlying subprime risks, thanks to assumptions of low default correlations and subordination, where junior tranches absorb initial losses. In a low-interest rate environment, institutions like banks, hedge funds, and insurance companies chased these safe high-yield assets to meet regulatory capital requirements or boost returns. CDOs backed by subprime MBS offered yields 1 to 2% higher than similarly rated corporate bonds, attracting massive inflows. Synthetics like credit default swaps, CDS, further amplified this by allowing CDO creation without physical assets, with synthetics making up 31% of CDO collateral by 2005 to 2007. Banks' lending practices created a chain of reaction that led to the collapse of the housing market. As subprime borrowers defaulted, rates jumped from 7 to 8% expected to 20 to 30% actual. MBS values plummeted. Early defaults forced originators to buy back loans, leading to bankruptcies and tighter credit. Since many CDOs were built on subprime MBS, even small MBS losses wiped out junior tranches, then hit senior AAA ones due to high correlations in defaults, contrary to models assuming diversification. House price appreciation, slowing to 5%, was enough to trigger massive downgrades. Total SFABS CDO issuance from 1999 to 2007 was $641 billion, with subprime MBS dominating later vintages, over 50% by 2006-2007. Leveraged institutions holding AAA CDO tranches faced huge losses, leading to insolvencies, e.g., Bear Stearns, Lehman Brothers. CDS failures amplified this, as counterparties couldn't pay out. Markets froze, halting debt rollovers and trades, mimicking bank runs. Write-downs on SFABS CDOs reached an estimated $420 billion, 65% of issuance, with 2005 to 2007 vintages accounting for 90% of losses. Senior AAA tranches averaged 55% write-downs, while junior ones hit 90 to 100%. What was the government's response to the crisis? To remedy the financial crisis, around 2008, governments used massive bailouts like TARP, injected liquidity into banks via central banks cutting rates and buying assets, passed fiscal stimulus packages, tax cuts, spending, supported key institutions, Fannie Mae, Freddie Mac, and reformed regulations, Dodd-Frank Act, to stabilize markets, prevent collapse, and encourage lending and job growth. The Treasury injected cash into struggling banks via the Troubled Asset Relief Program, TARP, to prevent systemic collapse, while the Federal Reserve provided massive loans and bought securities to keep markets functioning. The Obama administration implemented the American Recovery and Reinvestment Act, RRA, of 2009, included tax cuts, increased unemployment benefits, and infrastructure spending to spur demand and create jobs. Moreover, central banks slashed interest rates to near zero and engaged in quantitative easing, buying assets, to lower borrowing costs in order to rebuild the economy. While these measures prevented the recession from turning into a depression, they negatively affected the middle and working classes. These measures bailed out financial institutions and the wealthy at the expense of the working-class families, which led to the resentment of many middle-class and working-class families against President Obama, as they felt betrayed that he sided with Wall Street rather than Main Street. Many applauded President Obama for making the economy stronger under his presidency, but his economic policies did not genuinely prop up the economy. Quantitative easing did it by inflating the value of assets during the Obama presidency, which made the economy appear stronger than it truly was. Under the Obama administration, wealth inequality grew considerably, and that was a failure on the part of President Obama's economic policies, since his goal was to reduce wealth inequality.